Christoph Iggo, you are Chief Investment Officer, Fixed Income of AXA Investment Managers. We had the elections in Italy. We also had the downgrading by Fitch of Italy. But this doesn't move the markets. They're quite relaxed. Why is that?
I think the markets are still very much of the belief that the ECB will eventually come to the rescue. Draghi said something very important last July when he said they would do whatever it takes to save the euro, and I think many investors believe that. What happened was investors bought into Italian and Spanish debt towards the end of last year, and they're still convinced that that's the right thing to do. In addition, I think there's very strong domestic support for the Italian bond market. However, I do think there is a period of uncertainty ahead which could lead to higher yields.
So are markets a bit too optimistic now?
I think they could be. We don't have a government in Italy, and the election result showed that the Italian people are not happy with austerity and reform, and that's what we need to stabilise the fiscal situation. So I think we could see some more volatility in the Italian market.
So how important is Italy for the Eurozone?
I think Italy is very important. It's a very large economy, and it really is a bellwether of how the Eurozone is dealing with the debt crisis. If Italy can be put back on track, maybe with a technocrat government or a coalition, then things should be okay. But if things go wrong, that brings into question the stability of Spain and the outlook for countries like Portugal and Ireland.
You haven't talked about France. A lot of experts see France as a problem in the Eurozone, or upcoming problem. How would you judge that?
Well, I think France does have problems. There's no growth in the French economy, and the government will miss its budget deficit targets for this year. So I think the big risk there is that the spread of French bond yields over Germany would widen, or at least remain quite volatile. There is clearly a risk that the rating agencies will downgrade France again in the coming months.
So that brings me to the next question. In the last two summers, summer 2011, summer 2012, the financial markets were in deep trouble. Could that happen this year as well?
Well, I think there's clearly a risk around Italy and what happens there. But also outside of Europe, we've got some interesting events taking place. We've got the sequestration in the US. We've got a change in policy regime in Japan with the Bank of Japan. And I think generally central banks are doing something quite unusual in that they're telling the markets they're willing to accept more inflation. And that could create some problems for bond markets, for government bond markets in general. So I think this year the problems may not be in the Eurozone, they may be outside of the Eurozone.
And how much of an impact would that have on the markets?
I think if the central banks continue to ease policy, we will see steeper yield curves with longer yields rising and inflationary expectations widening. I think the best opportunities are outside of the government bond markets. They're in parts of the market like corporate credit and high yield, where the yields are still quite attractive relative to government bonds.
So what are the most attractive markets also in geographical terms for bond investors these days?
I think Europe is still quite attractive on the corporate side and the high yield side because deleveraging is still taking place, and that's good for credit. I think the UK credit market is attractive because it's the cheapest of all the credit markets, and the one I would be least comfortable with is the US, partly because the US is so far advanced in the economic cycle that yields are likely to suffer some upward pressure and credit spreads could also widen.
And the corporate bond market, do you have some attractive markets?
Yes, again, I think sterling is quite attractive in corporate bonds. It's probably the least bad market at the moment, but generally investors are happy with corporate bonds, and I don't think we'll see any outflows from corporate bond funds as part of any kind of great rotation. I think it's still a solid market.